This is ICT with a 6th installment of the 8 teachings of September 2016 ICT mentorship. We're going to be specifically dealing with fair valuation in this teaching. And fair valuation comes in the form of 2 perspectives. Fair value in regards to equal distance of a high or low, or what we would call equilibrium, or fair value for the perspective on valuation as regards to market makers. And I'm going to combine both of them to give you the perspective that you have to have when you look at price. This is actually a chart that we mapped out in advance, talking about a lot of these very specific things here in the week of this tutorial's production, September 24th, 2016. We called Australian dollar higher based on the things that I'm going to cover here. I was aiming for 76.65 as a weekly objective, and you can clearly see here the market did in fact hit that. What led to these ideas behind me giving these upside objectives from an area down here? Well, first, you have to understand there's a lot of overlap from what we just covered in the previous 2 sessions, that being equilibrium to discount and equilibrium to premium. Obviously, if you're a buyer, if you want to be buying, you want to be looking at a discount market. That means trading in the lower third of the current trading range that the market has presently or currently created in its most recent impulse leg or impulse price swing. The sells are best taken in the most current trading range or impulse price swing, upper third portion of that range. Okay, that's a premium market. We're selling at a premium. When the market returns back to an area of fair value, that is a fair value for the market maker to either sell or buy. In this case, we're going to cover, again, both concepts in regards to equilibrium and the fair valuation for market maker participation in price action. This swing here, just making this high here, the market broke down and it quickly ran away. And this is what we call a liquidity void, where the market makes a sudden movement lower and it's large ranges, very little wicks, very quick movement. That is a void. That means the price spent very little time trading at these price levels, and it was in a hurry to get down to this area here where it started trading more efficiently back and forth on both sides of the candle and ultimately having a retracement. This range in here, as soon as we see pockets of price action where there's sudden movement lower, just like we saw a quick sudden movement lower here, this up candle at the bottom of that, that's where we start watching and measuring fair value. And the down candle here